Hey guys, Tarek Backus here with Whole Net Worth, and in today's video I want to talk to you about getting started investing in the stock market in 2019. In today's video I'm going to touch on the steps that I would do if I were to get started again today, and I'm just going to get right into it. So the first step is to educate yourself. And like anything in life, what you want to do is educate yourself. Make sure you understand what you're getting into before you start. And I have a couple of tips for you guys. So the first one is I just dropped the book. The first one is to get a couple of books, and a couple of books that I recommend, and I mentioned this already. One is The Richest Man in Babylon. I don't know if you can see that there. The Richest Man in Babylon. That's a great book. That's not really a stock market book. It's a book that's going to help you in terms of understanding the philosophy around saving and investing. It's not really for the stock market, but it does help you in terms of understanding how to invest and how to allocate your money so that you can save it. The next two books, the next book is, I highly recommend this one. It's called The Idiot Millionaire by Derek Foster. I'll get a little closer there. I don't know if you can see it. Please try and find this online. I know it's hard to find now. I don't know if he's publishing it as much anymore. He does have a website. The author is Derek Foster. I'm pretty sure if you Google him or type in The Idiot Millionaire, you can find his website. I think his website is stopworking.com or stopworking.ca. So definitely do check it out. I bought this book. It was $20, and it has translated into tens of thousands to hundreds of thousands of dollars in profits for me over the years, just from reading this book. It gives you idiot-proof strategies on idiot-proof stocks, how to pick them, what to look for, and maybe I'll go on that a little bit later in another video. But basically, looking at companies that have people paying for their services on a monthly basis, on a regular basis. So if the economy were to crash or to tank, these companies are still making profits. For instance, your phone provider, you're always paying them on a month-to-month basis. So for instance, if the economy were to crash, you're still going to pay your cell phone bill every month, most likely. If the economy crashes, you're most likely going to brush your teeth every month. So companies like Procter & Gamble that own Crest, or Colgate, Palmolive that owns Colgate toothpaste. So that's the philosophy that book gets into, and it's similar to Warren Buffett's philosophy, but it's a great book. The next book, if you want to get into it a little bit deeper, is Stocks for the Long Run. This is by Jeremy Siegel. He's a Wharton professor of the Wharton School of Business. This book is really thick and it's really dry, but I've gone through it. I'm not all the way done. I have a little bit left to go, but it really goes into the analytics of the stock market and how stocks are one of the best investments for the long run. And it's proven to be the best investment over any other asset class in the long run. And he shows you graphs, he shows you statistics over the last, I think, 100 or 200 years. So great book, but definitely do get the Idiot Millionaire one. It's an easy read. You can read that in a day. It's written so easy, and it's helped to educate me. So first step is education. Step number 2 is save. You want to make sure that you're saving money. And this you can do in parallel. So while you're educating yourself, you can start putting money aside. The first rule of investing is to make sure you have money to invest, and that's to save. So you have to save. That's the first rule of investing, is to make sure that you have savings so that you can have money to invest. Extra savings, extra money that you can use to risk and put it in an investment. Because remember, an investment is not guaranteed, but you want to be able to have something there so that you can have an opportunity to gain more money when those opportunities come. And you want to have savings because you don't want to have to dip into debt or emergencies. So make sure all your expenses are covered. Make sure that you have saved some money that you're willing to say, hey, I can take this money and I'm willing to put it in the market, put it into some stocks, and put it into some companies to earn more money and take a little bit of a risk. And what you're going to do to reduce your risk is you're going to educate yourself and make sure that you're investing in solid businesses. That way your risk is lowered and you're able to get good returns with the money that you have saved. Step number 3, you're going to open an account. Whether it's a brokerage account or an account with your financial institution, you're going to open a stock trading account. So you're going to go to your bank and you're going to say, I want to get started investing in stocks, in the stock market, and I need to open an account for that. Your bank, your financial institution will have an account that you can open and you can start to fund, or you can go with other brokerages. I know there are some online brokerages. I'm in Canada. I use Questrade. I think there's also E-Trade and a bunch of other ones in the States. There's some other ones up here in Canada as well, but I would do my research to see which one works better for you. With your bank, you might be comfortable because you have all your banking and you do all your banking with your bank, so it might be easier for you to transfer money. However, the banks tend to charge a little bit more for purchasing stocks. So every time you have a transaction and you're investing in a company, they may charge you a little bit more than a discount brokerage. So for instance, if I were to go with my bank up here, they're going to charge me $9 per trade. But if I go with a discount brokerage, they'll charge me like $5 per trade. So it depends on your comfort level and what you want to do. I would research that. The 4th step, so the 4th step is to purchase. Once you've done your education, you've saved some money, and you've opened an account, the next step is to get out the fear and just get into the market. So what you want to do is you want to make sure that you're ready to go and purchase. Now you've educated yourself, you've picked a company, or you might have picked an exchange traded fund. And I should have talked about this a little bit more. An exchange traded fund is an index fund almost similar to a mutual fund where you're invested in many companies or a cross section. For instance, the S&P 500 index, where that fund is invested in all the top 500 companies in the United States. And that's one of the ones I would recommend starting with first. Start with an S&P 500 ETF. You can purchase that the same way you're purchasing a stock. And this is where you would build up your foundation of wealth. Start by putting it into solid ETFs and blue chip companies. So blue chip companies, again, will come from similar types of companies that were in the book that I mentioned, The Idiot Millionaire. That gives you a little bit of idea of some of those companies. So I would start with that type of philosophy. Start purchasing ETFs and some blue chip companies. Now, I would start small. Don't start putting all of the money that you've saved. Let's say you saved $5,000. Don't put all $5,000 into one company. Maybe take $2,000 and split it up and put $500 in 4 companies. And then the next step is to monitor. Spend some time to see how your stocks are performing. Get comfortable with the market. The market is very volatile. It's going to go up, it's going to go down. So what you want to do is you want to get a comfort level to see how the stocks are reacting. The reality is, unless you have money in the stock market, you're really not going to watch it. You're really not going to monitor it, and you're really not going to pay attention. Once you have some skin in the game, once you have some money invested, that's when you're going to start to actually take notice and actually watch and monitor the stock market to see how it's going up and down, how those companies are doing. And you have to get comfortable with those fluctuations. And I would give yourself a 3 to 6 month time frame and just let that go and see how that works. And then that brings you to the 6th step, which is add to your positions little by little. Now that you've monitored it for 3 to 6 months, now that you've gotten comfortable with it, now you can either start adding to those companies that you already have. You can invest a little bit more into them, Or if you want, maybe you're researching some other companies, you can invest a little bit more into those companies as well. So that's what I would say for step 6. And the 7th step is really to repeat. So what you're going to do is you're going to repeat this process, because what you're going to do is you're going to continue to educate yourself as you're going, and you're going to learn more and get better and better as you're saving. Maybe not, you don't need to open the account anymore, but then you're going to continue to add to your positions. You're going to purchase more stocks as you go along. So when I say repeat, you're going to repeat educate, you're going to repeat save, you're going to repeat purchase and monitor, which again is adding to your position. And there was one more final step that I want to talk about, which was step 8, and that is to, when you're investing, make sure that you're keeping your funds in there for 3 to 5 years. Look at it like you're putting it away for 3 to 5 years, because in any given time frame, in the short term, the stock market can drop by a lot. So I want you to be aware that, if you're investing in your money, you need to be able to be comfortable and know that you're going to kind of keep it in there for 3 to 5 years, just to have that comfort level that if the market does drop, you can wait it out as the market goes back up, so that your money returns to where it was and that you can earn more, or your investment can rise as the years go on. So I just wanted to touch a little bit on that. The first rule is educate yourself. Second is save, open the account, purchase, but do a very small purchase. I would start with an ETF, because you're diversifying and you're reducing your risk. And then I would pick some blue chip stocks. I can go on to that in other videos, but you can research that a little bit. What type of companies are blue chip companies? And then I would also monitor it for 3 to 6 months, get comfortable with the market going up and down. And then after that, I would start adding to my positions slowly over time as I get more comfortable in the market and as I continue to educate myself. And know that every time I invest and I'm purchasing a stock or investing in a business, that I'm going to keep it in there for a minimum of 3 to 5 years. I hope this video helps. It was a kind of spur of the moment. I was a little bit flustered going through it. Leave some comments in the comment section below. Let me know how I can improve it. If it was really bad, let me know if you really want me to redo it all over again, and I will. But I really wanted to get this information out there. This is how you can get started in the stock market, get started having your money make money for you, so that you can live the life you want to live and live the life of your dreams. Again, Tarek Bacchus here with Whole Net Worth. Thanks for watching.